US stocks surge more than 2% to fresh record highs as stock investors celebrate Donald Trump's re-election. But bondholders aren't so sure. US Treasury yields jumped 18 basis points to a 6-month high as traders bet on tax cuts, higher borrowing and growth. Meanwhile, New Zealand's jobless rate rose less than expected and Malaysia held rates. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Head of FX Research Mahjabeen Zaman analyses the currency implications of that election win, following a sizeable jump in the US dollar overnight.
Given that Trump's policies are likely going to lead to larger deficits and much more borrowing, that expectation is driving US Treasury yields higher.
But first, in 5 and 5 with ANZ, Donald Trump has all but been confirmed as the winner of the US presidential election, with a Republican sweep of the House and Senate also likely. By afternoon trade in New York at 4 a.m. Sydney-Melbourne time, the result has seen the S&P 500 rise more than 2%. The Dow and the Nasdaq are both up more than 3%. The US 2-year Treasury yield was up 8 basis points and the 10-year was up 17 basis points as investors positioned for tax cuts and higher borrowing. ANZ Head of G3 Economics Brian Martin says an expansionary policy program will come in over the top of an economy which is currently in a sweet spot.
President Trump and the Republicans are very much seen as the party of business. And that's led to very strong gains in stock markets, which are up about 1.9%. When I last looked at the S&P 500, we have seen bond yields, though, also move higher. And I think the anxiety there in bond markets is that Trump is pro-low taxation. And on that basis, does that mean that we're going to see a deterioration in the budget deficit over time, that there will be higher bond supply?
The US dollar index was up 1.7% at 4 a.m. Sydney-Melbourne time. As a result, the Aussie dollar was down 1.06% at 65.66 US cents. And the Kiwi was down 1.05% at 59.40 US cents. Number 2. Brian says Donald Trump's tariff agenda might also have an effect on those US interest rates and around the world as well.
Europe has said that higher tariffs from the US would be negative for its growth outlook. It's something that central bankers have been speaking about recently. And indeed, De Guindos from the ECB today was saying that higher tariffs are negative for economic growth. So the expectation is that if President Trump does go ahead with a higher tariff in the United States on imports from Europe and indeed other parts of the world, that's going to necessitate lower interest rates from other central banks. So we saw quite a sizable move in Euribor today.
Number 3. The US Federal Reserve will also be watching the market reaction closely today ahead of its interest rate decision tomorrow.
We have seen the expectations for a rate cut from the FOMC tomorrow stay very steady. And in fact, expectations for a December rate cut have actually increased slightly. And the market is now putting over a 70% probability of a 25 basis point rate cut. I think for the FOMC, they're really going to have to wait and see what the policy landscape is going to be. And that could well be the middle of next year or, the back end of 2025 before you get the clarity that they will need to see how it is impacting the inflation and labour market, which is the key parameters they use for setting interest rates.
Number 4. In New Zealand yesterday, the unemployment rate rose from 4.6% to 4.8% in the September quarter. That was lower than the 5% forecast by the Reserve Bank, but employment fell 0.5%, slightly more than expected. ANZ senior economist Miles Workman says, all in all, the data points towards a 50 basis point cut in the OCR at the end of the month.
You could argue that chatter of the potential for a 75 basis point cut in the November meeting is likely to quieten down a little bit after these data. The broader economy and demand for labour are quite weak, but because the supply side of the labour market is responding to that weakness in demand, it has left the overall labour market slightly tighter than the Reserve Bank were forecasting.
Number 5. Malaysia's central bank had a rates decision yesterday, opting to hold at 3%. ANZ economist Arindam Chakraborty says the central bank highlighted resilient domestic expenditure and higher exports as pointing to sustained strength in growth.
Going into 2025, inflation outlook will remain subject to the implementation of the petrol subsidy rationalization that is likely to be carried out by mid-2025. The upside risks to inflation will depend on the extent of the spillover effects of the subsidy rationalization. However, BNM expects inflation to remain manageable next year. We continue to think that BNM will remain on hold in 2025 as we do not see a case for a rate cut considering Malaysia's stable inflation and growth outlook.
Aaron Dam Chakraborty there. Now, in our bonus deep dive interview, ANZ Head of FX Research, Mahjabeen Zaman, looks through the currency implications of a Donald Trump election win.
The key currencies to watch is clearly the US dollar, which continues to move upwards. We have got the Mexican peso and the Chinese yuan, which are also going to be sensitive to these results. And at the same time, of course, within the G10 space, we think that a euro and yen are likely to be most sensitive to any outside dollar moves, and that's really on the basis of a dollar yen. That's a function of the dollar yen yield differentials, and given that Trump's policies are likely going to lead to larger deficits and definitely much more borrowing, clearly that expectation is driving US Treasury yields higher, and clearly that's really not supporting the yen, and we've seen a weaker yen overnight.
So what does that policy platform look like?
Trump's first 100 days are likely going to include perhaps reducing corporate taxes. Tackling immigration is one of his top priorities. In foreign policy, he will likely impose across-the-board tariffs on imports. Within the US-China relationship, again, securing strategic independence from China will be in focus along with targeted higher tariffs. While Trump does have the power to pass new tariffs and immigration rules, again, depending on the makeup of Congress, if divided, some of his policy programs might be challenged. The Republican policy or program really covers two broad agendas, tariff and fiscal. Now, the upside in US dollar will present itself via both of these channels. Some of this, of course, prior to the elections was priced in. We saw dollar move higher through the month of October, but we do continue to see a little bit more upside overnight, and it's really a function of not just the election outcome, but also the fact that there has been ongoing US exceptionalism. Now, US growth is well above long-term trends, and this is on the back of the data that we have seen so far. When we think about Fed rate cuts, this week we do expect the Federal Reserve to cut interest rates by 25 basis points. But, going into next year, perhaps given that economic resilience in the US is continuing to stay, this is probably pointing to perhaps a less aggressive easing cycle ahead. I guess the Fed is in no rush to ease rates if data continues to look so good. And so again, we think that would be dollar supportive as well.
What could this mean for the Aussie and Kiwi dollars?
The Aussie and Kiwi naturally are a little bit lower on the back of the results. But at the end of the day, I think the Aussie dollars downside will remain limited. We had the RBA meeting this week, and still there was some element of hawkishness in the tone as we read it. RBA is one of the only major banks to have not started easing as yet. We're calling for a February start to the easing cycle. And I think to some extent that yield differentials in a world where everyone else in the major economies is cutting rates, those yield differentials should give some element of support to the Aussie. Another thing to also note is that into year end, we tend to see risk assets outperform. And when risk assets outperform, they tend to benefit cyclical currencies such as the Aussie and the Kiwi. So coming into December, it generally tends to be a seasonally strong period for both the Aussie and the Kiwi dollar, not just because only of risk assets outperforming, but at the same time, also we tend to see New Zealand exporter demand tends to kick in a much larger way because meat and dairy exports tend to pick up during this time.
Mahjabeen Zaman there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, November the 7th. Catch you tomorrow with further market reaction to those US election results. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.